Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to the Get Rich Education Podcast, show number 7. I am your host, Keith Weinhold. In the last episode, I spoke about how home equity is not the good investment that some people think it is. Since last week, I had questions from 2 listeners, in fact, basically asking me, don't you have to pay a private mortgage insurance premium, PMI, which is usually hundreds of dollars a month if you have less than a 20% down payment or 20% equity on your primary residence? The good news is I'm here to tell you that no, I don't make any direct PMI payments on my primary residence, and I only made a 5% down payment at purchase, yet I still got a great conventional 30-year fixed amortizing interest rate of 3.5%. I will tell you exactly how I did that at the beginning of the next episode. It's a creative strategy with conventional financing that has really surprised some people. I'm sorry to tease that for next week, but for this week, I want to devote time to our first guest. Yeah, after you listen to our first guest, you will want to consider what amount of leverage is right for you. So yeah, I'm appreciative that in the first 6 Get Rich Education episodes, you let me do all the talking in order to lay the foundation and set the tone for the show. Well, the monologue streak has been broken. Our first guest is here to talk about global economics. This is important. Before we go ahead in the future and drill down into specific geographic markets in those future episodes, it helps to understand economic dynamics from a global perspective before we put our head down into whatever national, regional, or local market that we choose to invest in. One reason that our guest is here is because, frankly, I cannot talk about global economics quite like my guest can, and that guest is author, economist, consultant, and speaker, Mr. Richard Duncan, a U.S.-born economist whom is based in Asia. I first heard about Richard through Robert Kiyosaki of Rich Dad, Poor Dad fame. I've always liked Richard's approach because he can make complex concepts sound simple. Even so, though, it's kind of the material that you may have to listen to more than once in order to connect the dots. You'll find that closer to the end of the interview, I do begin steering Richard toward how you can respond and position yourself within today's global economy. And at the very end, Richard also shares a special gift for Get Rich Education listeners. So I'd rather use more time to let Richard talk, so let's go ahead and jump into the interview recorded earlier this same night here, this last week of November 2014. So of all the interviews granted by one of the world's leading economists, the latest one is right here on Get Rich Education. Here you go. Richard Duncan is the publisher of the video newsletter Macro Watch, which you can find at richardduncaneconomics.com, and he's the author of 3 books, The Dollar Crisis in 2003, The Corruption of Capitalism in 2009, and The New Depression, The Breakdown of the Paper Money Economy in 2012. Since beginning his career as an equities analyst in Hong Kong in 1986, Richard has served as global head of investment strategy at ABN AMRO Asset Management in London, worked as a financial sector specialist for the World Bank in Washington, D.C., and headed equity research departments for James Capel Securities and Salomon Brothers in Bangkok, Thailand. Richard also worked as a consultant for the IMF in Thailand during the Asia crisis, and he is currently the chief economist at Black Horse Asset Management. Richard has frequently appeared on your television on CNN, CNBC, the BBC, and Bloomberg Television. Here he is, the incomparable Mr. Richard Duncan. How you doing, Richard?
Keith, thank you very much. Yes, I'm well. Thank you.
Yeah, well, from here in Anchorage, USA, where it still hasn't snowed yet this season, out to you in Bangkok, Thailand. I hope this finds you well. So, I've got to ask, first of all, Richard, how did you get to be such a renowned economist and author based over there in Asia?
Well, Keith, I grew up in Kentucky and went to Vanderbilt. And after Vanderbilt, really by chance, I ended up backpacking around the world for a year. And I saw Asia in early 1984 when I was 23. And I realized it was booming economically and that it would be a land of opportunity for me. So after a couple of years in business school back in Boston, I moved to Hong Kong and found a job in 1986. And I've been in Asia most of the time since then, watching this incredible economic boom unfold here for the last few decades.
Well, I've heard you state before that economic growth is something that used to result from production growth. But now we've sort of shifted to a system where economic growth results more from credit growth. Is that something you can expand on?
I think it's very important for everyone to understand that the economy doesn't work the way it used to. And it doesn't work the way that it is taught in textbooks. And that's because all of classical economic theory was written back in the 1700s and 1800s when gold was money. Well, we are now no longer on a gold-backed monetary system. We have a pure fiat monetary system now where the government is free to create as much paper money as it wants to. And this has changed absolutely everything. So that's the first thing everyone needs to understand. Before the Bretton Woods system broke down in 1971, and the Bretton Woods system was a kind of quasi-gold standard, that's when everything changed. Before that, it is true that under a capitalist system, economic growth was driven by businessmen who would invest, and some of them would make a profit. They would save that profit and invest again. That drove the economic growth dynamic or the growth process under capitalism. But now things have changed. The economic growth is no longer driven that way. It's no longer driven by investment and savings. Instead, it's driven by credit creation and consumption. So let me elaborate on that just a little bit. Once we broke the link between money and gold, in other words, once the government no longer had to back up the paper money by holding gold, this removed all the constraints on how much credit could be created. And what we saw in the United States was that total credit in the country first went through $1 trillion in 1964. And over the next 43 years, as credit exploded, we went from $1 trillion of total credit to $50 trillion of total credit by 2007. So a 50-fold expansion of credit in just 43 years. And this credit explosion, you could say it created the world we live in. It created very much more rapid economic growth than would have occurred otherwise. It ushered in the age of globalization by allowing the export-led countries in Asia to sell their goods to the United States on credit. But the problem is that in 2008, all of this credit couldn't be repaid. And this global bubble that had formed came very near collapsing into a new Great Depression. So yes, so it's no longer investment and savings that's the primary driver of economic expansion. It's been credit growth fueling consumption. And the problem now is that it doesn't look like credit can continue expanding because the private sector in the U.S. already has too much debt and it can't take on more debt. So the credit, it looks like we're stuck. And that's really takes us to the heart of, you could say the heart of this economic crisis is we no longer have enough credit growth to drive the economy.
So if we no longer have sufficient credit growth to drive the economy, what's a potential consequence or outcome?
Let me back up a bit and just say that going back almost all the way to World War II, anytime the United States had less than 2% credit growth adjusted for inflation, then we had a recession. And the recession didn't end until we had another big surge of credit expansion. So let me just repeat that. Going back to 1951, any year that credit in the United States didn't grow by at least 2% after adjusting for inflation, the U.S. had a recession. And that recession didn't end until we had another big surge of credit expansion. Well, after 2008, we have not had 2% credit growth in any year in the U.S. And consequently, this has forced the U.S. central bank, the Fed, to introduce a very unorthodox policy, quantitative easing. And by printing now $3.5 trillion since 2008 and using that newly printed money to buy financial assets, the Fed has managed to push up asset prices, stock prices, and home prices, and this has created a wealth effect. Household sector net worth in the United States has expanded by $25 trillion since the low in 2009. And this expansion of wealth, that has allowed the Americans to keep consuming more, and that increase in consumption has driven economic growth in the U.S. But this is the direct result of the Fed's policy, and we wouldn't have had the economic growth without quantitative easing. So without sufficient credit growth, this has forced the Fed to drive the economy. So it really comes down to this. The economy doesn't work the way it did in the past. You have to understand that a large global credit bubble has formed, and that bubble is in danger of collapsing into a new depression. And it's only the government intervention through very large budget deficits and massive amounts of paper money creation that's keeping this global economic bubble inflated. So once you understand that the government is actually managing the economy, this is crucial, because if you're going to invest wisely, you must understand this. The government is managing the economy at the macro level. And therefore, to invest wisely, you have to anticipate what the government is going to do next, because that's going to determine whether the asset prices move up or down. Now, you don't have to like this arrangement. You may not feel comfortable that the government's managing the economy. If you want to make money as an investor, you better understand that this is the reality. And you're going to have to anticipate the government's next move in order to invest successfully. So in my video newsletter, Macro Watch, I believe that credit growth drives economic growth, that liquidity determines the direction of asset prices, and that the government attempts to control both credit growth and liquidity to make sure that the economy continues to grow. Those are the things I focus on in Macro Watch in order to anticipate how the government's next move is going to affect the economy and asset prices.
Now, I know that some have commented that they feel that at least the United States has an inflationary mandate. With all of the government debt, we can basically help inflate away our debt if we have inflationary policies, QE policies, where we do more printing. Do you think inflation then appears to be a more likely prospect in the shorter term, or could the deflationary forces of globalization offset that? What do you think we're headed for? More inflation or more deflation?
Well, this is another important way in which the economy has changed. It's no longer just the national economy that everyone has to look at. We now have a global economy. And in the past, say go even as recently as the 1960s, if the U.S. government spent too much money, as it did under President Johnson, when the U.S. was spending a lot on the Vietnam War, as well as domestic social welfare programs, the Great Society programs, that excessive government spending led to domestic bottlenecks. And pretty soon there was full employment and capacity was being fully utilized in all the industries. And this very quickly led to wage pressures and inflationary pressures. And so we had a wage push inflationary spiral in the 1970s as a result. Paul Volcker crushed that inflation in 1980 with very high interest rates. and causing a severe recession in the United States. Then President Reagan was elected, and what he did, he cut taxes and radically increased military spending. So that increase in spending and government debt, that revved up the economy again. In many ways, this was a replay of what President Johnson had been doing. I mean, by spending too much government money. But this time, in the 1980s, we didn't have inflation. And the reason we didn't is because starting in 1980, really for the first time ever, the United States started having very large trade deficits with the rest of the world. And so the increase in government spending in the U.S. didn't lead to inflation in the U.S. because we no longer had just a domestic economy. We had a global economy, and we started buying more and more goods from Japan and other countries all around the world. And after 1990, China entered the global economy. And now the United States trade deficit with China alone is more than $300 billion every year. And in China, 80% of the people earn less than $10 a day. So as a result of this, the United States manufacturing jobs have all been relocated, mostly have been relocated offshore to low-wage countries like China. And so we no longer have domestic bottlenecks. We have a global economy. And within our global economy, there's massive excess capacity across almost every industry. There's no danger of hitting full capacity anytime soon. And in terms of labor, out of the global population of 7 billion people, 2 billion people live on less than $3 a day. So there's certainly no danger of wage push inflation. And on top of that, after now 4 or 5 decades of extraordinary credit expansion in the United States and in other countries, everywhere around the world now we have enormous amounts of excess capacity. Steel and any industry you name, China has too much capacity. And so the tendency is for prices to fall. In other words, we have a global credit bubble on a giant scale. And without continued government intervention in terms of large budget deficits and quantitative easing, then this global credit bubble is going to deflate into a depression. And in that scenario, we will have falling prices. We will have severe deflation, the way that we did in the 1930s after the credit bubble of the 1920s imploded. So the natural tendency, without government intervention, the natural tendency of the global economy is to deflate and prices will fall. In order to prevent this from happening, the government has intervened in the United States and in Europe and Japan and in China with very large budget deficits around the world to create more demand to absorb this excess capacity. And they've financed these with enormous amounts of paper money creation. And so in this way, they've managed to keep the global bubble inflated. Now, the danger is if they print too much money, then we could move into high rates of inflation. But at this point, the greater danger seems that we're going to have deflation. In Europe, we're moving rapidly toward deflation. Japan has been struggling against deflation for decades. In China, at the wholesale level, prices have been falling for 32 months. And even in the US, the inflation rate is well below 2% at the CPI level. And now global commodity prices are falling, most obviously oil, which is also putting downward pressure on prices. So it looks like in the near term, the greater risk is that we will have deflation rather than inflation.
I listened to a year-old interview with you, and remarkably at that time, you did state essentially that oil looked precarious at $100 a barrel, and today we sit below 75. You were sort of foreshadowing a fall there almost a year ago. And at that time, you also stated that quantitative easing would start to taper soon, and it soon did. So I found it remarkable that what you stated there effectively has become true a year later. What's your economic outlook for 2015, 2016?
Okay, well, so I believe that if we look for the next couple of years, it seems to me that we are still not going to have 2% credit growth in the United States. And without that, I believe the economy will be very weak. as it always has been in the past. During last year, the Fed, through quantitative easing in 2013, it created more than $1 trillion of paper money. And with that newly created money, it bought $1 trillion of financial assets. Well, that was more than enough to finance the U.S. government's entire budget deficit last year, which was only about $700 billion. And all of the excess liquidity pushed up the stock market by 30% and pushed up home prices by 13% last year. So as a result of quantitative easing, the net worth in the United States last year alone increased by almost $10 trillion. And that expansion of wealth has been driving the economy. But now, throughout 2014, the Fed steadily reduced the amount of paper money it was creating every month. And in October, it stopped creating any new paper money through quantitative easing. So now, I think without this stimulus provided through quantitative easing, and particularly given that credit growth is due to remain weak, I think the U.S. economy is going to weaken again. And I wouldn't at all be surprised to see a significant stock market sell-off over the next couple of quarters. And if that occurs, if I'm right in that scenario, then I believe that once again, the Fed will launch a fourth round of quantitative easing, QE4. And that when it does, stocks will shoot up again, and that they will end higher by the end of 2015 than they are at the moment, but only after there's a significant correction and only after the Fed intervenes again with QE4. There's a reason they keep numbering these rounds of quantitative easing, 1, 2, 3, because they keep happening again and again. I don't think QE3 will be the end of it.
Well, Get Rich Education advocates ownership of real assets, especially real estate. So in this era of funny money, real assets should retain value. Do you feel that way? And do you feel that prudently leveraged cash flowing real estate investors are positioned well in this constant global uncertainty, holding on to something that should retain value?
Yes, I do. I do believe that the central banks are going to have to continue printing a lot of funny money over the years to come. And as they do, I believe real assets will continue to appreciate in value. My first book, The Dollar Crisis, was published in early 2003. And since that time, the dollar's lost more than 75% of its value against gold. That trend is very likely to continue, I believe. I do believe in owning gold, but even more than gold, I think it's wise to invest in land with houses, rental property, in other words. And I'd like to distinguish between condominiums and land with houses. There's no limit as to how many condos can be built in the world. You can build a lot of very high-rise condominiums. But if you own a piece of land with a house on top, you can rent the house out. And so mortgages are near all-time low record levels. You can borrow money in the United States at a fixed rate for 15 years at very low mortgage rates and buy a piece of land with a house on top with that, and you can rent out that house, and over 15 years, it will more or less pay off the mortgage. And meanwhile, and afterwards, you will have then essentially ongoing cash flow forever after. And meanwhile, you'll also probably have capital appreciation in the value of the land. They're certainly not making any more land. So yes, I like gold, but I like land and houses even more because they have a cash flow, whereas gold does not.
Boy, you're really speaking my language there. I want to know, Richard, if you had ideas and information to provide to a 25-year-old investing enthusiast today, what sort of things would you tell them?
I think for younger people, it's very important that they do things and learn things and know things that other people don't know. You need to develop expertise in something so that you will have a particular skill yourself. In my case, traveling around the world when I was 23 for a year was just an invaluable experience. It changed everything. I saw the world. All the time I was traveling, I read a lot of history books about all the countries I traveled through. And it didn't take a great deal of intelligence to look around Asia and see how rapidly it was growing. So that gave me an incredible advantage that most of my peers back home in the United States didn't have. So any sort of an experience like that will really provide enormous benefits to you for the rest of your life. I'm a big believer in reading a lot of books, particularly history books. If you want to know what's going to happen in the future, or your best chance of getting it right is to understand what's gone on in the past and the trends that are carrying on from the past into the present. Many of them are likely to carry on into the future. So if you understand where we're coming from, then you'll be able to understand where we're going. And finally, I would advise everyone to think for themselves. Don't listen to what everyone else is saying and doing what everyone else is doing. You need to have enough understanding from reading and your experiences to be able to think for yourself and judge whether the consensus is true or whether it's wrong. Very often it is wrong. You can see in all of the stock market bubbles that we've had over the last couple of decades how frequently the consensus is wrong. So think for yourself.
Invest in yourself. Knowledge is the new money. So from your macroeconomic standpoint, is there anything else that our listeners, most of which are in the United States, can take forward?
It's a very confusing time for everyone because, as I mentioned at the beginning, the economy really works very differently now than it did in the past. And once the crisis started, the U.S. government started running trillion-dollar budget deficits, which of course was very alarming to everyone. And then the Fed began this extraordinarily unorthodox policy of printing money like crazy in order to prevent the economy from collapsing. And very many commentators now in the United States never cease to repeat again and again that their belief that the government is just making things worse and that the government should stop intervening in the market and allow market forces to work, to allow a new equilibrium to be established through market forces. Well, I can understand why they believe that and why they think that is correct, but I would just warn everyone that I think that would be a tragic catastrophe. Things have changed. We have had such an extraordinary economic bubble develop over the last 4 or 5 decades. Now that we've moved off the gold-backed monetary system, we've had an explosion of credit. Credit has expanded now since 1964. It's now expanded 60 times since 1964 as of today. If we allow this global credit bubble to pop now, as it would without the government intervention, then we would have an extraordinarily protracted economic depression that would be at least as bad as that experience during the 1930s. And I fear that it would be so catastrophic that no one alive today would live long enough to see the recovery. So we're not back in the 19th century when we had a capitalist system with no government intervention. Things have changed 180 degrees. We have an enormous worldwide credit bubble that the government has managed to keep inflated. And if they don't continue to keep it inflated, it will implode. So we have a different kind of economic system now. And everyone, it's not necessary or important that you like this economic system that we have now, but it is very important that you understand that it is entirely different than it was before. And this system is fueled by credit expansion. And we now have a global credit bubble on a massive scale. And the government is the only thing that's keeping this credit bubble inflated. If it deflates, it will be a catastrophe. So instead of allowing it to deflate, we should encourage the government to continue to keep it inflated, but not by spending trillions of dollars wastefully, as they're doing now. We need to learn from Japan's mistakes. Japan's economic bubble popped in 1990, almost a quarter of a century ago. And the Japanese government has prevented the Japanese economy from imploding into depression by having very large budget deficits every year. And Japan's government debt, as a result, has increased from 60% of GDP up to almost 250% of GDP. And in that way, they've kept Japan from collapsing into depression. But looking back on it, they have wasted all of that government money that they've spent. If they had realized 25 years ago that their crisis was going to go on for this long and that they were going to have to spend so much government money, they wouldn't have wasted it all the government spending. They say they've wasted it building bridges to nowhere and paving the Japanese countryside with cement. Well, we need to learn from that lesson in Japan. The US is going to continue to have very large budget deficits and most probably a lot of quantitative easing for years ahead. But rather than just wasting all of this money the way the Japanese did, or the way the United States has wasted it over the last 5 years on too much consumption and on unnecessary wars, instead we should take that government money that will be spent one way or the other, we should take it and invest it in new industries and new technologies. And if we spend this money, if we invest this money sensibly in new industries and technologies, then it would induce a new technological revolution. And these investments would be so enormously profitable that they would pay for themselves many times over. And we could lock in another American century. So rather than insisting that the government balance its budget and ban the Fed, which would result in economic collapse and geopolitical catastrophe, instead we need to understand that we have a different kind of economic system now, one that's going to require the government to continue to be involved with spending. And if we understand that, then the government could be encouraged to spend in a way that actually generates benefits through developing new industries and technologies, rather than just wasting all the money the way that it's done in the last several years on too much consumption and war.
Yeah, well, if these aren't great reasons for motivating one to learn more, then I don't know what is. So, hey, this has been a highly insightful discussion, Richard. Why don't you let our listeners know where they can find you?
Okay, thanks. Yes, please go to my website, richardduncaneconomics.com, and there I hope you will subscribe to my video newsletter, Macro Watch. Macro Watch, essentially, it's every 2 weeks I upload a new video presentation. And these are essentially me making PowerPoint presentations describing developments in the global economy and anticipating how the government is going to respond next and how these things will affect economic growth and asset prices. And Keith, if your listeners do go there and hit the subscribe button, if they use the coupon code GRE, they'll be able to subscribe with a 50% discount. So I hope they'll check that out. The coupon code is GRE, and that's at richardduncaneconomics.com. The newsletter is called Macro Watch.
That's a very generous offer for our listeners. Richard, thank you very much. Get Rich Education is about self-sufficiency and educating yourself. And from a global and a macro picture, I don't know of any better resource for staying up on that than Macro Watch. So go ahead and enter coupon code GRE, which stands for Get Rich Education, for 50% off. Richard, thanks so much. It's been great.
Okay, Keith, thanks. Nice talking with you. Let's do this again sometime.
Let's do that, right?
Okay.
Bye-bye. So there you have it. If you want to be an investor today, you need to realize that the government increasingly controls the economy. Whether you like that fact or not, that's the way it is. I am a Macro Watch subscriber myself so that I can follow these developments unfiltered and directly from Richard Duncan. Hey, if this is your first Get Rich Education podcast, listen, know that most people think that learning how to make their money work for them is the best and highest use of their time and money. At Get Rich Education, we show you every week how to get far ahead because you learn how to ethically make both your money and other people's money work for you. If the Get Rich Education podcast provides value to you, we would really like to have you as a regular listener. In order to best do this, go to your listening device, and when you're inside Get Rich Education, touch the subscribe button. That way, all future episodes are delivered to you. Of course, subscriptions are completely free. And hey, special thanks to Richard Duncan today. Now go out there and, though you might quit your day job, don't quit your day dream.
You've been listening to the Get Rich Education podcast, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.